Welcome back to another edition of Girard's Monthly Market Update. I'm Jim Jacobson, and with us today is Chief Investment Officer Tim Chubb. Thank you for joining. So Tim, back in late January, Jumpin' Jerry Powell and the Federal Reserve swing band met. They drank beer, they played some cards, they wrote some music, or maybe they actually set some policy. Tell us a little bit about that. More importantly, what might they do in their meeting coming up in mid-March?
Yeah, it's actually Jerome Powell's a pretty good acoustic guitar player from what I've heard. But,
Oh.
the meeting was relatively uneventful is what we wanted to hear as far as investors were concerned. Rates were unchanged, a little bit of tweaking to the plumbing when it comes to the OER and maybe some guidance on the repo stimulus that we've been getting for quite a while now. But overall, it was unchanged. They're relatively optimistic about where the economy is currently at, seeing an environment where necessarily changes to the Fed funds rate, whether it's lowering or hiking higher, is not necessarily in the cards right now, just because we haven't seen the inflation. Although the unemployment rate is at a 50-year low, everyone's been talking about as we have clients who are business owners about wage growth and how hard it has been to find people. We haven't necessarily seen the inflation moving close to that 2% target, where the Fed would get really concerned and need to raise rates further. So, overall, good meeting. I think the guidance for March will definitely be continually sitting on their hands, not really moving rates in another direction or another, and hopefully getting some more guidance around what is ultimately going to happen in the repo market, which is hopefully going to be winding down in April.
So it's fair to say no major policy changes, some tweaks here and there with the repo rates and things like that. Excellent.
Exactly.
So now looking at something totally different, we have this coronavirus, or what I like to call beer battered bat stew, not to make light of this thing, but in my take, the media is kind of making a little bit of a big deal about something that maybe isn't that big a deal when I look back at SARS and Ebola, dengue fever, Zika, but it is a little bit perhaps different this time just because of the scale of the economy. What's your take on this?
Yeah, that's the thing that really concerns me. I mean, there's been a lot of media coverage talking about how similar it was to SARS in 2003. But, the Chinese economy was 1/5 the size it is now as a relation of contribution to GDP globally. So the economy is more significant. If China catches a cold, sneezes, the whole world might catch a cold at this point with how large the economy is. And so it makes me concerned. I think anytime you have, 60 million people quarantined for some period of time, it's going to have, some sort of impact on the economic data. And, the question is, what don't we know at this point? How long is it going to last? How is it going to change sentiment? And it's not just in the Chinese economy. The Chinese consumer is very important for the European economy. We've seen them being, very active in buying luxury goods there and in New York and real estate. And so it's very important. And I think, people need to realize and take this thing a little bit more cautiously than maybe we took some of these other pandemics.
So if we look back at history, I know with SARS in 2003, the market pulled back about 10% initially, and a year later it was up almost 20% as measured by the S&P. Very similar with dengue fever, and then kind of most recently Zika in 2016. And I think that one made some big headlines because it was Brazil, it was the Summer Olympics. So is it fair to say, though, that a short-term move shouldn't really change what a long-term investor is doing?
Exactly. I mean, these tend to be knee-jerk reactions. The market tends to get out of its system in 4 to 6 weeks, and ultimately, looks like a good buying opportunity. But I think, as investors invest outside the U.S. long-term because, frankly, the valuations are more attractive and they're lesser attractive here in the United States. And also because the growth outside the U.S. is so much more significant for a variety of reasons. I think you can avoid, investing outside. And I think while you need to be concerned about what's going on with how this could potentially impact the global economy, it could be a great opportunity for you to dollar cost average and get some more exposure.
Exactly.
Towards the end of last year, got some news about the Secure Act. It was sort of slid in there right before the end of the year as we were all celebrating the holidays, but had some major ramifications both for corporate retirement plans as well as individual investors who maybe have already retired and are expecting that they'll be collecting their required minimum distribution at age 70 and a half. Tell us a little bit about what's changed.
Yeah, it's an interesting thing. So for folks that are turning 70 and a half this year, they do not have to take an IRA distribution. So I know I've been preaching for 15, 20 years, hey, when you hit 70 and a half, you have to begin taking this money out unless it's a Roth IRA. But the fact is now the law has changed. So the Secure Act has changed that required minimum distribution age to 72. So for those that are already 70 and a half last year, you have to stick with what you're doing.
Yep.
But for those folks that are turning 70 and a half this year or beyond, they do not have to take a distribution until 72. And the other thing that's interesting is for those that are still working, for those that have earned income, whether it's self-employed income or they work for a company, they can now contribute to a traditional IRA. They could always contribute to a Roth, but now they can contribute to a traditional IRA. And that's kind of a game changer for a lot of people that don't need the money and that are looking to continue to save. So a couple other things that have changed, and I think this is the biggest one, although it's going to take time to play out, is the inherited IRA. So give me an idea. Tell us a little bit about what our baby boomer clients might see there, Tim.
Yeah, the big thing that a lot of clients used to take advantage of is, trying to plow as much money as they possibly can into a Roth for funds that they don't think that they're going to need for estate planning purposes, because, the next generation would never have to take out the money. Not the case anymore. There's a 10-year limit in how long they have until they have to take out their money from a traditional IRA, from a Roth. So I think that's resulting in a lot of updates to financial plans, updates to estate plans that, originally felt like, things were right on track, but as the rules and regulations have now changed, require some dusting off and getting under the hood and making sure that, their wishes are still aligned with how the law is currently written now.
And I think this opens up the opportunity for grandparents, maybe older baby boomers, let's say, to think about naming grandchildren as beneficiaries. And then this also brings into the case life insurance planning. So lots of different things, lots of subtleties, and it'll all be customized. So the other thing I think the Secure Act is worth noting is the fact that it changes some of the rules regarding small business plans. So 401k plans are generally thought of as large businesses, but SEPs and Simples, they were for small businesses. They're able to aggregate these assets now. It gets a little wonky and it gets a little bit deep for our discussion today, but suffice to say, I think give us a call. We'll bring our retirement plan services team to the mix.
Great.
All right. Well, thank you very much for joining us, Tim. And thank you for joining us. Again, I'm Jim Jacobson. This is Tim Chubb. We look forward to seeing you again next month.